We are officially live on YouTube for the Thursday edition of the Not Your Average Investor Show. Today, we've got guest expert Paul Shively talking about places that most people don't even realize that they have access to capital. I am your host, Pablo Gonzalez. With me, as always, the man that I affectionately like to call GC, because he's got these genius concepts, because he knows how to generate cash flows, because he's a great co-host. And as a coincidence, his parents also called him Gregg Cohen. Say hello, GC.
Hello, everybody. Great to be with you.
And our community manager is always in the house. She is here to help you out. If you're confused about anything in the chat, you reach out to her. She's here to help, here to connect the dots for you. We call her MTM because she brings us the moments that matter. And because her name is Madison the Magnificent. Say hello, Madison.
Hi, everybody.
And of course, the man that oversees over $1 billion in investments. He has helped more people than anyone ever reach passive income goals. That's a fact. You can check it out on ChatGPT. He is known as the Jason Statham of real estate because of his dashing good looks and because he can really kick some butt out there if he gets challenged. Paul Shively, like sixth time on the show. I got to start keeping track. I can't count that high, man. Welcome back.
I'm honored, brother. I'm honored. I love it. What it really is very selfish of me because I just come back for that intro to make me feel good about myself, right? And then I go on with my real world for the next 2 months. And then I just, but I come back for my daily dose of Pablo that makes me feel good about myself. So thank you, my friend. I appreciate it. I love being here. I love being here.
Love having you, man. We love starting this as a safe space. And then we start to make fun of each other as the call.
I love it.
I was going to say, when do we get to start making fun of him and not just building them up?
GC, we got you round one pre-show, man. So it's his turn.
I was going to say, yeah, the tally, the score is a little bit lopsided. You guys need some better game, or you need some more coordinated efforts because we gotta even this out at some point.
When you have like your best boys that you've been friends with, your best boys you've been friends with for like 10 years, 15 years. If it starts getting too complimentary, something's wrong. I feel that's a little bit kind of where we are with Paul right now. So we're going to have to make sure that he's ready for the challenge that is the Not Your Average Investor Show.
Well, I saw Danica put something in the chat that said, hi, Danica. Good to see you. Or good to, have you on. And so she can give you all the inside stories as well, too, because she's been with me for like a decade. So she can give you all the inside stories and scoop that'll help you have a little bit more fun on the show. Let's just call it that.
Love it. Well, we always start the show with a little tradition we have. First, I want to welcome you if you're joining us for the first time. You're a Fortune Builders alum or a Fortune Builders community member. We do this twice a week. We invite you to keep showing up here. We show up Tuesdays, we're teaching a concept. Thursdays, we are generally going over portfolios and different strategies. But we'd love to have you 12:30 Eastern every single week, Tuesdays and Thursdays. Also, if there's anything that you find interesting on this show, that you want to take the next step, that you want some one-on-one guidance on, the way to do that is to talk to JWB's team, chat with jwb.com, and they will sort you out. They're great at finding sources of capital and or showing you just how well your capital can do already that you already have. That's what that first call is about. It feels great. But the other thing that feels great is a little tradition that we have around here. GC, you know what we're talking about? You know what we're talking about, Paul?
I know now from last time. I'm excited. We even had a phone call about it later. I'm like, how do I get the nickname, man? I love it. So I'm excited.
That's right. We're talking about the roll call, baby. We got Lita Song kicking us off. She's a new community member. Good to have you, Lita. We got our leadoff hitter batting second today. GC, you know who our leadoff hitter is?
John Henning, of course.
John Henning. We got the MVP of the Not Your Average Investor community.
Lee Bishop.
We got the ringmaster of the Not Your Average Investor community.
None other than Andrew Barnhill.
We got the second family, Gary and Rosalind Riley from Murrieta, California. We regard you. We got the early bird checking in.
Dean Curry.
We got the patron Santorios of the Not Your Average Investor community.
Michael Santorios.
We got Leo Faraganan.
Dun, 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 dun.
Faraganan.
Dun, 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 dun.
We got the mountain man from the Deary Mountains of Colorado.
Billy Green.
We got Big Papa in the house. We love it when he calls it Big Papa.
Pops, how are you? Good to see you, my man.
Greg's dad would call Big Papa affection. We got Tony D is back. Tony D, welcome.
All right, Tony.
We got a new friend here, Solomon Akanki, new to the show from Minnesota. Welcome to the show.
Welcome to the party, Solomon.
Yeah, we got Dion Taylor, another new name as well. Good to have you, Dion, as well. We got Danica checking in. Everybody knows Danica saying hi, Shively. I will assume you meant hi, Shively, Pablo, and Greg. That's fine, Danica. It's cool. We'll see you. We got Brian Boyer, Brian and Liz from Illinois, a couple some new people as well. Fantastic. We got Ra Preston from Orange Park, Florida. Ra, good to have you. We got Game Time Gamison in the house, GC. We haven't seen Tamara Gamison in the house in a minute.
That's right. We've been missing her. It's so good to see you, Tamara.
We got Martha Olaleye from Brooklyn, New York. We got Eddie Harris from Atlanta. We got the patriarch and matriarch of the first family of the Not Your Average Investor Show, Ken and Carrie Lynn Moline.
We salute you.
And we are gonna kick it now. All right, that is the first scroll. We don't want to take it too long. All right, I got to give what's up to Gregory Troncales with a what's up. I like big friendly check-ins. Paul, good to have you back, my friend. We love having you on here to teach these deeper concepts. I think this one's going to be really, really useful because most of the time when folks are trying to build passive income, when folks are trying to get into the real estate game, the thing that I hear the most, and I'm pretty sure that the JWB team hears the most, is like, yeah, I'd love to do this. I love the numbers, but where do I find the capital? But you guys, the two of you have had so many conversations over the years that I know that you are used to finding sources of capital for folks that they didn't even realize they have. I'd like to just start there, right? Like, what is the most common source of capital that investors forget to look up, Paul? Let's start with you.
Yeah, it's interesting because we've been having the same conversation and the answer really is almost the same, 10 years later, 15 years later, Greg, right?
Mm-hmm.
And in fact, I'm in Charlotte meeting with some other team members that I now manage and help grow, this side of the business. And even the team members that are, now my newly fresh employees, they're still having the same conversation with me. I literally had it last night over some beers and some chicken wings in Charlotte, North Carolina. It's the same conversation, whether you're in California or Florida, wherever you are. And 15 years later, it's the same conversation. Exactly what you just said, Pablo, is, oh man, that sounds awesome. I want to do it. And this group is awesome because this group has already taken a couple steps down the road to getting started and doing that and taking control of their financial future, which is fantastic. But it's the same question. Okay, well, where do I start first? Where do I go first? Right. And that's what we've been doing, Greg, and your team has been doing. Passive Income Club at Fortune Builders has been doing for 15 years. Is step one is do that diagnosis. Okay, where is your capital currently? And the first thing we really go to is, what are your retirement accounts doing? Right. And that's the number one. So that's the short answer to your question, Pablo, is retirement accounts is the number one thing. And I said it again last night over a couple of drinks with some of my buddies here, and they were blown away. They were like, wait, no, you can't use your retirement account to invest in real estate. That doesn't work. Right. And that's the normal standard answer. Well, how do you do that? That's illegal, isn't it? Right. And they have no idea that if you make some strategic moves, right, namely, we can talk about it, Greg, I don't want to steal too much thunder, but we do have to self-direct some retirement accounts, but there's some specific sources, specifically older employer retirement accounts, so some older 401ks and IRAs. So those are two that people have no idea that they can self-direct. And we can talk a little bit about how to do that, how that works. And then you can invest in real estate. You can invest in commercial property. You can do hard money lending. It's a huge source of capital that most Americans, and specifically most investors, don't know they can access, right?
You see, you've been on the front lines more than usual lately, right? You host the show. You've been doing a lot of outreach these days. In your, even right now, in your most recent experience, where does the conversation tend to go as far as like, I didn't realize, I can't believe I got this much couch money to invest in real estate?
Yeah, I mean, it's the number one reason that people say that they can't invest, but it's also many times the easiest problem to solve, the easiest obstacle to overcome when we get to sit down and actually have a conversation with a potential client. And, Shively hit the nail right on the head there. Retirement accounts are a huge opportunity for you to, find the capital to be able to invest in rental properties. And it's not just because rental properties offer better return on investment or more consistency. The reason that I shout this from the rooftops that this is possible, that, our clients are doing this, passive income clients are doing this, that I do this, that Shively does this, is because if you just take out the better returns, more consistency that comes with single family rental property investing, and you just look at how overly dependent Americans are on the stock market for their retirement accounts, it's pretty much all people know how to do and can do most of the time. Just for the idea of just diversifying and not being overly dependent on the stock market, there's a big value that people are seeking the opportunity to move into a different and better asset class. So yes, retirement accounts are a huge opportunity for those folks to be able to find the capital. Most of you didn't know that you had the opportunity to do it, but that's what this call is about. It's about letting you know that you can, and then there's teams here to help you, navigate that process, which, can be scary if you don't have somebody holding your hand.
Yeah, man, that makes a lot of sense. And again, if you're hearing about stuff that sounds scary and you just need the dots connected, The main thing, if you want to do a deep dive into it, go to chatwithjwb.com, jump in with experts. But the other thing I just put in the chat is we have usually 50 to 60 people that show up to all these calls, a very, very friendly, outgoing community, willing to help. So if anything in here doesn't ring true, feel free to put it in the chat, and you're going to get a whole bunch of help from people there. And if you want to ask a question live, put it in the Q&A, because I know that chat's going to go real quick so that we can suss it out and we can have the two good looking fellas I have here in front of me answer those questions. But let's get started, right? We talk about how do you put it to work, right? Like if you found it in a 401k or an IRA, or correct me if I'm wrong, many people, I know this was my case, right? Like many people have changed jobs in the past and have an old 401k, old IRA that they've just kind of had on cruise control for a while and haven't really tapped into, right? Is that what we're talking about here?
Yeah, I'll just go ahead and jump in here. Yeah. So let's kind of identify specifically some sources of capital within your retirement accounts that you may or may not know that you had access to. The first one that you brought up there, Pablo, is a great one. An old IRA. Many people think that when they leave their job, that the best thing to do is one of two things: either just to leave that IRA and roll it over into call it a traditional IRA with a traditional brokerage, or they just sometimes roll it back into their new employer 401k plan. And the challenge with that is you have this beautiful opportunity when you leave a job with a whole lot more flexibility that comes with what you do with your retirement account. You no longer now are getting a match from your previous employer. But at that moment, your old IRA or your old 401k can be rolled into owning real estate or private lending or some type of asset there. And you really don't have the restrictions or the holdbacks that you have if you're still currently employed and earning that and having that 401k with that provider. And specifically, if you're currently employed with that 401k and it's under your current employer, you still can access this. We'll talk about things that you can do here, but you're still getting your match. So you kind of have a little bit more restrictions when you leave your job and you have an old 401k or an old, IRA. That's time to sit down with a provider like JWB and say, okay, well, now I'm thinking about going into real estate. What do I do here? And it's a lot simpler at that moment right there.
Paul, you've helped many people do this, right? Like, so they find it, they know that they want to do it. What's the next step at that point when you're generally giving folks advice?
Yeah, I think the first step is helping people get over the fear. I think helping people understand and kind of naming it to taming it, right? Like name the fear of, oh, I didn't know I could do that. And that's, makes you queasy a little bit. And I'm moving your money and money's moving and things are happening and people are touching your retirement account. And it's like, oh, I thought I never could touch my retirement account. Well, if you do it the right way and follow the rules that the, SEC and IRS set them out, it's the same rules that I play by, that Gregg plays by, that you play by, every American plays by the same set of rules, right? Problem is most people just don't ever read the rules. How many of you have sat and read the IRS tax code? Even on this call, how many people have you done? Yeah, right. So
I did it early on when people told me that I couldn't do it. I was like, right. I think there's something to that. Let me go and check it out. So I'm with you. Yeah, I did.
Actually go and read it, right? And so once you read the law, read the rules that are set out by the people who control the game, like, okay, well, they say I can do it. Here's exactly how I do that. And that's the education piece, right? And how I think we conquer fear and how we start to take action is we get some education in there, right? And JWB is phenomenal at this, right? Chatwithjwb.com is phenomenal. If you need that education piece, that's exactly why you jump on the horn and go to Chat with JWB. Talk with, amazing people like Danica and like your team who can teach you all of this on a one-on-one individual basis, right? Mm-hmm. Which is huge. And that's the customization piece that takes us to a whole nother level. But the basic education, the 30-second version, right, is you do exactly what Gregg said. You've ID'd it, Pablo, you've ID'd an old 401k from a previous employer you're with for 4, 5, 6, 7 years, and you've amassed a decent chunk of money there, right? That's your money now, right? It's in your retirement account, but that's your money. You have the choice. Now, what you do is you make those election forms that are sent to you in the mail, right? Or these days in an email potentially, and you're going to get a choice. And you have to sign some paperwork to move it wherever you want. The default kind of normal American choice is to move it to your new employer, like Gregg said. Well, that's the same exact process. You're literally moving it from old employer's plan. So 401ks are plans technically, right? We're moving it from their plan that their company has to the new company's plan. Well, your option is you can say, well, I want to move it basically to my own plan. I want to control this. I want to self-direct this because I'm an educated real estate investor that's been listening to Gregg Cohen for the last 15 years on the Not Your Average Investor show. And I know how to do this, right? So you have the education that, well, wait a minute, I don't have to move it to my own employer, which most people think that's the only answer. The other answer is you can self-direct it, right? Now, in the self-directing, you have to follow the rules. And the rules are you can't touch it, right? Greg can't touch it. I can't touch it. You're moving it to basically a 401k bank, like a custodian, right? So instead of Charles Schwab, there's dozens and dozens and dozens. And there's nothing against Charles Schwab, by the way, right? I'm not picking on them, to be clear. There's dozens and dozens of other Charles Schwab-like companies that are self-directed companies. Now, what they are, think of them as a 401k bank. They hold your money in escrow, right? Like it should be. A 401k has to be handled separately with special rules. They do that for you, but they don't invest it for you. You get to choose where you invest it. And that's the education piece. Once you walk people through that, help them understand, they get on the phone with 3 or 4 self-directed custodians, right? They do their Google search, they talk to Gregg's team, they figure out some good ones, and they say, okay, let me call 3 or 4 of these, make sure this is actually real. They get educated. All of a sudden, that fear goes away, right? That Twitter-pated stomach feeling goes away a little bit, right? That we all have. And if you don't, you're kind of lying to yourself probably because it's your money. You probably should have it, right? When you're dealing with your retirement money. And that education piece helps lead to action. Okay, I can self-direct. I know how to do it. Here's my options of companies to do it with. Okay, then exactly how do I invest it in real estate? Well, we can talk to you about that. You take title of the real estate in the name of that 401k, right? So there's specific details you need to follow. That's a little bit of the nitty-gritties, but that's the first thing you go through, Pablo, is I want to make sure we touch on that is a little bit of the content, the meat and potatoes. Hey, here's the source of capital, but then here's exactly how you do it. And those are the steps. I did it in 45 seconds. You might want to, or 3 minutes maybe, right? You might want to schedule a phone call with Danica or chat with JWB.com. And you might want to do that to help your specific action plan go about that. And that's a 4 to 6 week process to do that, right? To roll that over, right? But that's, I think the biggest action I've taken notes. That's what you take notes on is exactly that what we just talked about, right?
I love how simply and directly you broke down the meat and potatoes. And I really love the fact that you gave credence to that fear, right? Like, I feel like you guys have both said, people think this is illegal. And I hear that all the time, right? That wasn't my first reaction, but I hear that all the time from you guys when you're talking about people thinking it's illegal. And then of course you have to show off that you read the tax code and all that stuff, but that's neither here nor there. But yeah,
the reason I don't have any hair and I'm gray at 35, let's be honest, right? I do weird stuff like that. So
yeah, it's one of the reasons we call this the Not Your Average Investor show, right? Like most of us here have had to overcome some kind of fear of making a mistake at some point, some advice from somebody that pretended like they knew what they were talking about because they were giving you just conventional wisdom. It feels like this room is a room full of folks that have faced the fear of advice, gone into real estate, not taken the average path. And that's kind of what brings us all together. So I think it's one of those getting over that thing. And how you get over it is the education. It's listening to the meat and potatoes, getting versed with it, get surrounded by people that can help you, whether it's this community or whether it's go to chatwithjwb.com and have them help you out. I know GC, I know on the education side, I think you've put together some slides to show us how this ends up working out. But there's a couple of questions that I want to ask real quick that are here in the Q&A. We got Game Time Gameson asking a question here saying, is there a way to leverage pension plans? Believe it or not, those are still out there.
Yeah, so they're still out there. You get, and we saw it a lot. And sorry, Greg, I'm just jumping in. Apologies. I'm the guest. I don't want to overhaul your shift. Sorry, my bad.
Love it, baby.
I have seen it before. Right? So there's teachers union pension plans that we've seen a lot. There's a lot of different types of pension plans. There's 506Bs. There's a lot of different things. There's 403Bs with education plans. There's a lot of different types of retirement plans. The biggest thing is you don't have to be the expert. That's the best way to answer this specific question is, yes, I've seen it. And yes, you can potentially, right? It depends. And Danica's probably laughing because I've used to say this 16 million times and she's heard me say it tons. It depends. Your individual company, your individual provider of that plan, that pension plan, that teachers union plan, that whatever it was, it has a unique set of documents. let the self-directed experts, who are those self-directed banks like we talked about, call them, send your document plans to them, and let them tell you that they're the experts. They have the lawyers and the attorneys and the CPAs who are all licensed to do this. Let them give you your specific answer, right?
Good
I
answer.
love it. I love it. I'll just add on, it's about being prepared to ask the right questions. That's kind of what I'm taking away from what Shively is saying here, and through education and support, you're able to ask those questions. Most Americans, we never ask those questions. But by simply asking those questions, you're going to find out that there's a lot more possible than you think.
I love that. It reminds me of, have you guys seen that movie Air about the Air Jordan? Have you seen
No,
that
but
come
I
out
want
yet?
to.
So a key scene in that movie is the guy that's trying to land Jordan, right? And they're by far number 3 to Converse and Adidas, because those were the big brands at the time. He goes to Jordan's mom, who's the controller of the whole thing. And when she's like, why should we go with you? He's like, don't worry about why should we go with you. Here's the questions that you need to ask Converse and you need to ask Adidas. And here's what they're going to tell you. If they tell you this, come back to me, because that's what this and this means, right? So like arming people with the right question is the right way, and worked out pretty good for Nike, right? So, all right, a couple more questions before we get into your breakdown. GC Lita Song is asking, what about Roth IRA? Can you do this with a Roth IRA?
Yes, 100%. You can do this with a Roth IRA. You can do this with a traditional IRA. You can do this with a solo 401k. You can rattle off all the different acronyms, and the general answer is you probably can do it with those. But absolutely. So we talked about what a great opportunity if you just happen to leave a job and to be thoughtful and strategic about how you're going to roll those 401k or IRA funds over, and the ability for you to put it into real estate if you put it with a self-directed company like Paul was just talking about there. But if you currently are with your employer and you happen to have IRAs, Roth IRAs, things of that nature, this message is also for you. If you're feeling like you're overly dependent in the stock market and all of your IRAs, Roth IRAs, 401ks are all in the stock market, well, this message is for you too. You can also roll IRAs, Roth IRAs over to a self-directed company and allow yourself the ability to invest in real estate as well. So yes, this is beyond just those who have just recently left a job.
Awesome. And in the chat, Tasmia Rahman asked, what are those banks? If you are here in the chat, you've done this before, put in the banks that you used to work with to do your solo 401k, give some value out here. I know that we use a handful of them here at the Not Your Average Invest Show community, so I'll let the community give you that. And then final question before we jump on your thing, Stefan Johnson says, does acquiring the property in the name of the self-directed 401k subject the 401k to legal? Paul, do you have that answer?
Yes. I'm not sure he's going to like the answer, because I would say everything's subject to legal. So I don't know what he means by subject to legal. There's rules and regs and legal you need to follow every single time you invest in anything, and every investment has risk, right? We all need to be aware of that and make sure that we're talking finance is really what we're talking about. It's real estate, but it's finance, right? So my disclaimer to that is like, yes, everything has risk, right? And let's all be big boys and big girls and have a big boy and big girl conversation on, yes, everything has risk. Yes, everything is subject to legal ramifications if you do something wrong, right? Mm-hmm. And there's rules you need to follow. I would say the most important people in your life are, aside from your family, your property manager who manages your wealth, right? And then your CPA and your lawyer, right? That's your real estate team, right? Like JWB should help you on the property manager side, a company like them. And your CPA and your lawyer are really, really important people in your life, right? So you should have that team flushed out. So yes, I wouldn't be worried or scared that it's subject to all the rules and regs that retirement accounts have and legal, but absolutely. And there's risk with everything. You need to make sure you do it correctly, right? Absolutely.
Got it. So specifically speaking, can a tenant sue a 401k? Can a resident sue a 401k?
I believe, yes, there are protections inside the retirement account that separate liability from yourself personally, much more like an entity, and you can even, we can get in a little bit of nitty gritty, but to show you the complexity that you can get inside of your retirement account, you can have entities inside of there. So you can have a LLC that's owned by your retirement account, which gives you an extra layer of protection. You can have trusts inside your retirement account, right? So you have the umbrella that's your retirement account. You can have a trust, you can have an entity, you can have a real estate privacy trust. We can keep going, right? So I liken it to the speed limit's 55. How fast do you drive, right? And Danica's probably laughing again because she's been with me for like 10 years and she knows this is the exact story I go to, because some people drive 80 in 55. So one person, Gregory, I guess, drives 250 in an 80 or 50. So, hey man, you do you, right? There's other people who drive 50 on the nose, right? So the layers of legal protection you want to put in your world is up to you. There's a simple, bare bones, easy way to do it. Then there's both extremes, right? And people do all, and there's nothing right nor wrong about any of them. It's a personal choice. Right.
These questions that we get about the legal side of this are really good questions to ask. We get those all the time, especially for something that's relatively new when we're talking about using retirement accounts to invest. Just know that there are experts and support here waiting for you that have done this not just hundreds of times, thousands of times. And so Paul's answer is exactly right. To your level of, risk mitigation, a legal plan is possible and can be put together with you and for you. And, that's the value of coming to a provider like JWB. We're a vertically integrated provider. We have all of those services either in-house here or one phone call away. And so to put that plan together to make sure that you're protected to the level that you want to be protected, easy peasy. Just, reach out to the team, go to chatwithjwb.com.
Yeah, that's exactly what I would say is that conversation is a one-on-one unique conversation for every single individual. And whether you end up investing or not, chat with jwb.com, schedule a call, get that information, because it's the secret sauce of all of this is the customization, the uniqueness of us, right? Like we're going to go through a case study now, which is awesome. And I think we're going to go through a couple other areas to find money that most people don't know. But the secret sauce of all of this, and I'm unabashedly like shout from the rooftops about this all the time, you need to schedule a call. You just do, because everyone's situation is unique. Greg's family is unique. My family is unique. Pablo's family is unique. The way you're investing, Pablo, is different than the way I'm investing. We have different investment objectives, and that's okay. That's good. So the content is like step one. Step two is customizing that content to you. And that happens on the phone, one-on-one, over Zoom, over Skype. Like that's what this is all about. That's where the rubber actually meets the road and you start to see results, right?
GC, you got that case study ready to go, brother?
Let's do it, man.
Cool, man. As you're whipping that up, Paul, I'm just going to tee you up to answer this question from Michael Santorios as Gregg is sharing his screen. And then I'm going to bow out because I got to go catch a plane, y'all. This has been great. So Paul, Michael says, with interest rates high, I know this may not be a popular way to raise capital, but I've used a home equity loan in the past. I know you got an opinion on that.
Yeah. I mean, I'm doing it right now. I've got my own home equity line of credit on a variable interest rate that I have right now, right? That I'm using that capital to invest, right? And so I'm a prime example of that. And yeah, there are a lot of different ways, and we're actually going to get into some of those ways, right? But there's, Gregg, I'm going to steal any thunder for later on, but I think it's a good segue because the community asked for it, right? Like one of the best ways or most common places most investors don't know where to look is retirement accounts. And another, which we can talk about later, is equity in their homes, right? Gregg, you and I talking about before the call. I mean, that's a huge one that most people don't realize, right?
We're just getting started when we're talking about finding capital here.
I know, there's a lot more we can cover. So I love that question. I can pause on that. I can get in details now, Gregg, it's up to you, but you can tap into equity, and HELOC is not, I'll tease you. A HELOC, a home equity line of credit, is not the only way to tap into that equity. There's multiple other ways that we can talk about and show you later that aren't necessarily just a HELOC, right?
Absolutely. We'll jump into that. I know Michael is one of our most experienced investors as well. And so I know he's really familiar, but that type of a question and that type of an idea as far as using a cash out refinance or using a home equity line of credit, I mean, these are tools that we can investigate and say, well, how is this going to make my money perform compared to my alternatives? And so that's the lens we'll look at it at through these case studies. Perfect segue though, as we start to get into some of these numbers. You all have probably seen this before when we talk about financials and we talk about investments. The big key here is that investors should do their own due diligence. So I would encourage all of you to do your own due diligence. Of course, what we were talking about are estimates and are not guarantees. And there's a whole lot that we, I think, just should adhere to as responsible adults, before you're going to make an investment decision. Make sure you do your due diligence, and we're here to help, but this is not financial planning advice. It's on you, as well as, your support network to get you to that place that you should be confident to invest. So with that being said, let's jump right into the case study here. And so I wanted to kind of take a leap from the theory of like, how do we move this money and what's possible to like, what this is actually doing for real life clients who have done a similar thing. So I put together the numbers here. And if you're a numbers person, raise your hand. I know in our Fortune Builders community, we got more numbers people out there. So, oh man, I love that you guys are raising your hand. I'm a numbers person. Shiley's a numbers person. Madison, Pablo, we're all numbers people. And so I'm glad that, this is going to emanate and resonate well with you. But what we're going to do here is we're going to look at reallocating $500,000 in retirement accounts into a portfolio of 2 rental properties. This is something that a client recently did for JWB. And I want to show you what they saw and why they took advantage of this opportunity. And Shively, you go straight into the numbers here. I would say just chime in at any point when you see a good talking point, and we'll kind of, ping pong back and forth. But a client came to us and they had money in their retirement account and they said, you know what, I feel like I'm way too dependent on the stock market. That ring a bell for any of you? Of course it does, right? So there was $500,000 that they said, you know what, this is in my retirement accounts right now. It's in the stock market. I'm not liking the way that this is looking going into a potential soft landing or recession. What can I do to proactively diversify out of the stock market? So that was their investment priority there. And we talked about their horizon, their time that they wanted to be in this investment. And for them, of course, it's a long-term investment. If you're thinking about investing in rental properties, it should be a long-term investment. So for this client, it's 20 years. And so they sat down, they went to chatwithjwb.com. That's where all of this starts. It's a conversation with you. We get to customize a plan for you. They sat down and together we built a plan to take that $500,000 that was in stocks and bonds in their retirement accounts and keep it in their retirement accounts, but simply move that over to a better asset for them, which was a portfolio of 2 rental properties. And we bought both of those properties with cash. So 100% down. We did not use financing for this portfolio. And here's the beauty of investing in rental properties, right? You get paid multiple ways. In the stock market, you generally only get paid one way. It's through stock price appreciation. But in rental properties, you can get paid up to 5 ways, right? And so what I put together here is a 20-year outlook of how this investment is estimated to perform, broken down by profit center. And some of these profit centers might be new to some of you. So if you don't understand what some of these mean, Paul and I are happy to go into this. But through this next cycle, this 20-year cycle, this cash purchase of investment properties, 2 of them, would net out over $580,000 in net rental income. Shively, you want to give a quick synopsis of what net rental income is?
Yeah, I mean, net rental income is your short-term. Think of it as, if you're comparing it to a stock, it's your dividend, right? It's your cash going, now in this case, going back to the retirement account, right? You purchase these in the retirement account. It's that monthly income that goes back to the retirement account, post expenses, post management fee, all that kind of stuff, right? So think of it as your cash on cash return. A lot of people are used to hearing that. If you don't own any real estate and you haven't done this yet, maybe you're one of the newer Fortune Builders investors and you haven't done this yet, and most of your money's in the stock market, it's your dividend from your stocks, which most stocks don't have a dividend, right? Most stocks are solely, what would be likened to home price appreciation down below, right? So this is your dividend. This is your monthly net cash flow hitting back to your account every single month.
There we go. So net rental income, your income coming in minus all of your expenses, taken into account things like maintenance costs and vacancy costs, tax savings, right? There's additional tax savings because this is in your retirement account, principal pay down of 0. Only reason that's 0 is because we did not take a loan on these assets. We'll see in the next case study that I put together where we actually did take out a loan, where you'll see that principal pay down profit center will be taken advantage of as well. And then you've got home price appreciation. Again, these are assets that are appreciating over time. Home price appreciation, for many people think that it's something they can't count on, but the data shows you that if you are a buy and hold investor and you look over full market cycles, those would be 10 to 20 years in real estate, things come back to the norm. The appreciation that happened over the last 40 years largely happens for 10 to 20 year segments going forward as well. So, that type of appreciation is significant. It's something you can count on as long as you have a long-term outlook. As well, we are benefiting from inflation hedging and inflation profiting. Real estate does that. It's a hedge against inflation, whereas other assets like in the stock market by themselves are just not a hedge against inflation. So you got all those profit centers working together for you. And here's how it ultimately looks out. If I ran the return on investment numbers, and IRR is a scary acronym for many people, it's the preferred way to determine what your return on investment is. This client put in $500,000. All they did was reallocate money that was overly dependent on the stock market, now put it into this portfolio of rental properties. And over 20 years, they're going to earn just about $1.3 million from those different profit centers that we talked about. Their total portfolio is estimated to be about $1.8 million. And if you break this down as a return on investment, it comes out to just under 9% return, a consistent 9% return. So the diversification of getting out of something they were overly dependent in, and the fact that they can still earn a 9% return roughly, is the big reason why the client was attracted to this. What do you think, Shively?
Yeah, I think two things jump out at me. It's a great case study. I'm super, number one, pumped for whoever did this, right? Because I've seen the impact of this. I've done it myself. I've done it with my father, right? I've done it for my brother. And I've been doing it for, that 5-10 year period already. And so I've seen the impact of this already and the change it's had and the amount of emotional satisfaction, but also freedom that comes with this, which is really nice. So that's the first thing. More on a teaching point is, I think you said two things that I have learned over time that I wish I knew when I was getting started. I was very dependent and really laser focused on the cash on cash numbers. If you go back one slide, I was really laser focused on kind of my net rental cash income, right? My net rental income. I was super focused on that. And I made decisions really solely based on that. And I was in that camp early in my career, and probably for too long in my career, that I kind of disregarded and I wrote off appreciation. I said, I want to be extra conservative and throw appreciation out the window. And I would even teach that, be extra conservative and throw appreciation out the window. And what I'm telling you is I've evolved, I've grown, and I think learned from the mistakes I made, right? Early in my career is you don't want to discount that because there is data that supports that. And as long as you believe in data and math, which most of us as investors do, we need to not be ignorant to that and the impact it can have. And as you can see mathematically, it's a larger impact, and really a large portion of the wealth that real estate creates is that. And so I've learned to broaden my horizons and broaden what I'm looking at when I'm making an investment decision beyond just the cash flow, beyond just that net monthly income number and that percentage, and get that broader impact. And I don't want to skip over that part. I think it's really, really important. And I think most people, it's not average, which is why this show is perfect. It's not your average investment show, but you're also not going to get the average results, because if you're taking that into account when you're making a decision, then you're looking at the whole pie, right? And I've seen the impact on my family. Like my father's able to retire early because of that exact income source. That, there's 4 income sources, or actually 5 now that you've taught me, Greg. And that home price appreciation is the sole reason, because we bought properties for him 5-6 years ago and they've appreciated, and we've reaped that and harvested that, and he's able to retire now. Like rubber meets the road. It's very, very simple when you break all this down. So that's the one thing I really want to hit and make sure we don't skip over, right?
I think it's a great point. I always ask folks the question, okay, sometimes people will say, I don't want to count on home price appreciation. I don't want to bank on home price appreciation. And I'll ask them what they're doing with their money right now. And a lot of them will have it in the stock market. And I'll say, why do you have your money in the stock market? Are you counting on stock price appreciation?
Exactly. It's the same thing.
And they'll say, well, yeah, of course. And what I point out to them is that, you believe that there's going to be stock price appreciation because over a full cycle, generally there's significant stock price appreciation. Well, it's the same thing in real estate, just for many reasons, more emotional reasons than anything, because we all were burned in some way from the Great Recession and saw home prices fall. We somehow have a different set of standards for when we can count on it. But at the end of the day, it's cyclical, just like stock price appreciation. Home price appreciation is the same. And without that knowledge, you will not make as good of decisions with your money because you will be missing a significant part of the profit equation when it comes to real estate.
Exactly. And there's data that backs that up. That's the beautiful part. Please don't take our word for it. Please do not. There's data that backs it up, right? Do your own research, right? Our job is to fast forward your career. Our job is to fast forward your success, right? But ultimately, like, please don't believe us. That's good, because you're going to be a more educated investor when you go research and look at the same data we have, right? That's a good thing.
100%. And if you want to see the data, that's a great opportunity to reach out to our team
Absolutely.
as well.
We'd love to send it to you.
Yeah. So just reach out. We'll show you what the home price appreciation levels have been in a market like Jacksonville over the last 40 years, because there's just a ton of misinformation out there. So anyways, we would love for you to reach out, and I'm happy to share this data with you. Again, go to chatwithjwb.com. Would be remiss if we didn't talk about the growing cash flows for this investment over time. Another reason why real estate wins versus the stock market generally is that your cash flows are growing as rents continue to go up. Rents go up at a faster rate than your expenses go up. And so your cash flows grow. And it's nice to see 1 year, 20-year segments of time, even farther out, as we all start to think about retirement and healthcare costs, to know that you have a significant amount of your retirement income coming from rental properties, and it's not volatile to the degree that the stock market is, gives people peace of mind at night. All right. So Shively, we talked a little bit about the retirement account side. Why don't we take a little bit of a step away from retirement accounts and talk about what sources of capital people don't know that they have, call it in non-qualified funds outside of their retirement accounts and their personal assets, bank accounts. What can we talk about there?
Yeah, I think the big thing is most people who have a significant or moderate to significant net worth have been told to find a good money manager, find a good financial planner, and start, build your brokerage account and start investing in the stock market. And I'm not saying that is a wrong piece of advice. I want to be abundantly clear. What I'm saying is most people don't take the time to look at that, exactly like you said earlier, Greg. Look at that compared to what your other alternatives are, and potentially rethink your diversification pie, right? I am not, I have 95% of my money in real estate. I'm not an advocate of that necessarily for the average investor, and that's okay. But, I live and breathe real estate every single day. I am all in on real estate. I don't advise people to be all in on real estate 100%. I want them to have a balanced portfolio, but I think the reallocation of what that balance is very different for most people, right? And I think, Greg, that's where you're going with this, is take a look at those money managed accounts. And kind of secret side ninja tip, please take a look at the fees they're charging you on those accounts. Please just read that again, right? We go through your fine tooth comb docs on what your money manager is charging you and what investments they put you in. And if it's not just like a blank ETF that they don't charge fees on, then I would highly recommend you please, again, look at the fees they're charging you on that, and throw that into the analysis as well too, right? I think that's the biggest one. And I think the other biggest one is the equity people have in their houses that they just don't really realize they can tap into, right?
Two great sources of capital. I'll throw some numbers that I've recently researched just on the equity in the properties that we as Americans have today. We have over $10 trillion in equity in the homes of Americans today because of the run-up of home prices over the last few years. Guys, equity in your home is a tool to help you accomplish your financial goals. If you don't look at the equity in your home as a tool, it's nice to have equity, but your return on equity is zero. What that means is if it's just equity and it's sitting there and it's not doing anything for you, your return on that is zero, when it could lead to passive income. It could lead to a better return. And so over 10 trillion, the average American is sitting on $200,000 of equity in their home. As we're going around the audience here, many of you are sitting on equity.
That's the difference. Sorry to interrupt you, Greg. I apologize, but I'm so passionate about this. That's the difference between paper rich and cash flow rich, right? Like, I don't want to be paper rich. I don't care about paper rich. I don't care about my net worth. I really don't care. How much cash flow am I coming in if I don't have to work? When my dad got sick, when I got sick, when I got to take 6 months off of work, how much cash flow is actually coming in? Like, that's rich to me. That's wealthy to me, right? Is how much time do I have and time freedom? And that's the exact definition. You got 200 grand in equity in a home, not doing anything to you. you're paper rich. It's not doing anything for you, right? And Greg, I got to go in a couple minutes because I have to catch a plane, just like Pablo. Apologies, but that one is exactly the reason as well to go chat with JWB.com and jump on the phone and let someone walk through. Okay, what properties do you have? What debt do you have on them? What's free and clear, and help determine what actually there is in tappable equity. And let's run the numbers, especially given debt terms today and how, because there's not just the HELOC way, a home equity line of credit to tap it. You can do a cash out refinance potentially. And that's a strategy I've used and taught a lot. In fact, we can share with JWB as well too. We have a whole refinance calculator as a tool you can use that we give to you to help you plug your numbers in to spit out, right, even at today's current interest rates, what the net result would be if you do take a cash out, and then what your new monthly payment is, and how does that work? Do you still cash flow? So if you have a portfolio of rental properties you may have owned for a while or inherited, that's a great another source and tool you can use. You can do it on your primary home. You can take a home equity line of credit. That's more of a line of credit rather than a refinance. But there's a lot of different strategies you can use. I don't mean to overwhelm you. What I'm trying to tell you is there's multiple different ways to do it. Let one of us chat with you in your specific situation with your property and help you find which one of those ways is best for you. Does that make sense, Greg?
I love it, man. That first phone call that we get to have with people is so much fun, right?
Awesome.
We get to sit down. We get to understand the resources that you have in different places. You get to share with us what your goals are. And then it's all data driven. We say, okay, well, we could put a portfolio together that could have this much debt. We might be able to do a cash out refinance of these assets and reposition that here. We might look at a home equity line of credit that could make sense for you. We can look at those retirement accounts. So that conversation for financial engineers, which Shively and I are, we just love it. So if you want to take us up on that offer, just go to chatwithjwb.com and we can take some of these ideas and strategies that we're talking about here and personalize it to you. Shively, I know you got to go. I know you got to go catch a plane. So before you head out, man, just want to say thanks for being here. We're going to keep going. I've got another case study for everybody. So we're going to say bye to Shively.
I'm going to put a challenge out there. There's 108 of you right now currently live on this. As of right now, I want to see at least 108 plus one of you still stay on after I leave. I don't want the big drop after I leave. This is Greg's show for a reason, right? So thank you for having me, Greg. I really appreciate it. Thank you for letting me be on and hopefully this helps, another family, right? That's the whole goal. That's why I still do it. Hopefully this helps one other family, two other families, three other families start to get on that path to really controlling their financial future. So I love it. Thanks for letting me share my knowledge. I appreciate it.
There's a reason, Mr. Shively, why you're in the Not Your Average Investor Show Hall of Fame, brother. You continue to bring it every time. We appreciate you, man.
Thank you. See you, everybody. Take care.
All right, guys. So guys, all right. So we've got this case study here now. Think about this. This is money that's outside of your retirement account. So we have some more possibilities of how we can engineer this portfolio for you that we just don't have when it's inside a retirement account. You can still invest inside a retirement account, but your debt structures are a little bit different. So if we can find money that is outside of your retirement accounts, then we even have more possibilities to put the portfolio together for you. And so I'm going to walk you through this case study, which is for those folks that might have a few $100,000 in a brokerage account in the stock market. And you may be saying, yeah, I don't know. I don't really feel like I want to have that much money there. Or I don't really like what returns are looking like over the next year in the stock market. Let me reallocate that non-retirement money in a brokerage account and move that over to a JWB portfolio. That's what this will be showing. So what we are doing here is looking at a client that had $275,000 in a stock market brokerage account, and then was able to turn that into a portfolio of 3 rental properties. If you remember before, it was 2 cash purchases with $500,000. Now, because of leverage, we're able to convert $275,000 into 3 properties. And we'll follow a similar structure that we did last time. So the client came over to us and said, listen, I want to reallocate money that's in that brokerage account into the stock, from the stock market into real estate. And we always ask, well, what's your investment priority? With this client, their goal with number 1 was to be cash flow, break even, or slightly positive. And they wanted to maximize long-term growth. The way to maximize long-term growth is to combine 2 things. It's to combine a market that has higher average home price appreciation with leverage. And so that's what we were able to do for this client. And their horizon happened to be 20 years as well. So now what we did is we Again, starts with a conversation. You reach out to us, go to chatwithjwb.com. We're able to sit down with you. We put this plan together and it turned into 3 purchases with conventional financing. That's what convfin means, conventional financing, right? And we put 35% down for the purchases. We use the remaining 65% of the bank's money to be able to take advantage of leverage. And here's what the total growth by profit center looks like after 20 years for this portfolio. So net rental income, over $150,000 in positive cash flow net rental income. Tax savings, again, we're able to earn money by deferring taxes that we otherwise would have paid because we get special write-offs for being real estate investors. Everybody on this call is able to take advantage of the tax savings that I'm referring to here. If you have more questions about that, of course, you can reach out to us and we can walk you through that. Principal pay down. This is your resident paying your loan down for you. How beautiful is it that you have somebody, all you got to do is give them a really great place to live and treat them really well, and they're going to pay your loan off for you. That's the relationship with a resident, right? We treat them like gold because number one, that's how we want to treat people. And then number two, it's because they're paying our loan off for us. I mean, if you don't need more of a reason to treat people like gold, I don't know what there would be out there. So principal pay down over $200,000, residents paying off the loans for us over a 20-year period of time. And then home price appreciation, over $900,000 here. And guys, this is based on average home price appreciation over the last 40 years in Jacksonville. And it's not overly weighted by the last few years, right? The last few years have seen above average home price appreciation. That's why we go 40 years back to get an average. And that's what drives this home price appreciation number, as well as inflation hedging and profiting. Again, we don't put a number to that because it can get quite complex, but that is real. You want to have an asset that hedges against inflation and actually profits when you take debt out on it, which is what you have in rental properties. You combine all of those profit centers, and here's how it would look for this investor. They brought $275,000 as their initial investment. We're able to return over $1.3 million over the next 20 years to bring their total portfolio value to just about $1.6 million. If you run the return on investment, you're going to see a return on investment of 9.7%, which is their IRR. So an incredible opportunity there to reallocate out of the stock market and then put it into real estate. And as we sort of round the call out in the next 5 minutes, the next step that I'm going to take you guys through is what would it look like if they just kept it in the stock market? Because maybe some of you are wondering that as well. So a 9.7% return on investment, your cash flows are growing over time. But guess what, guys? Cash flows, monthly cash flows, were never going to be the biggest reason why you should invest. Many investors are solely focused on cash flow. The mentality here is that break-even cash flow is a win so that the other 4 profit centers can bring that type of return on investment that you're looking for. It's easy to build a portfolio with more cash flow than this, I will point out to you. But what you give up is you give up growth long-term when you do that. So this client said, listen, I want to be break-even cash flow, slightly positive, and then I want to focus on max growth. That's why we built it this way. But over time, your cash flows grow, right? So in year 20, $2,000 a month of positive cash flow. If you go out to year 35, once the loans are paid off, then it gets really exciting, over $8,000 a month in monthly cash flow. All right, guys. So as we bring this train to the station here, now let's take a look at what would have happened if they kept their money in stocks and bonds. So I did a little bit of research here. And according to Vanguard estimates that the expected return on investment for a 60-40 portfolio in stocks and bonds will return 7% each year over the next market cycle. So 7% each year over the next market cycle is what Vanguard estimates for a typical 60-40 portfolio. That would mean 60% of the stock market portfolio is in stocks and 40% is in bonds. And they estimate 7%. If Vanguard's managing that money and they say 7% is what they expect, well, that sounds like the right number for us to expect as well if it was in the stock market. If you run those same numbers, that same $275,000, and you kept that earning 7% year over year for the next 20 years, your portfolio would be worth a little bit over $1 million, which sounds awesome and should be celebrated. There's nothing wrong with the stock market when it is part of a balanced portfolio. But when you start to think at what a 9.7% return can do in real estate, that $1 million kind of looks a little bit small, actually, because we could take that same portfolio and using those historical assumptions and using JWB's own metrics on how our real estate portfolios perform, our expected return and our expected portfolio value would be just about 1.6 in 20 years. So there literally is a $500,000 difference by making a decision like this. So guys, I think there's a lot to learn here. There's a lot to take in. You know, we were gonna spend a little bit more time talking about diversification, but guess what? We've had a great call and I want to be respectful of everybody's time. If you have questions and some of this stuff sort of makes sense, but you're not sure, or if this stuff really makes sense and you're sure you want to talk to us, this is the time to reach out. Go to chatwithjwb.com. My team is here to support. We hope that we can help you. But even if you have a question, you're like, how do I do this? We're here to support. We want to build a relationship with you. If now is the right time to invest, that's great. If now is just time to do your due diligence, that's great too. Reach out to us. We want to talk to you. Again, go to chatwithjwb.com. I want to say a special thank you to all of you for being on the call here with us. An incredible turnout, over 100 folks. We have our Not Your Average Investor community, which is alive and thriving. And for some of you who are new and this is your first time, we hope you enjoyed it and we hope you come back. We do this every Tuesday and Thursday at 12:30 Eastern time. If all you have to do is use that same email link that you had and just pop right in every Tuesday and Thursday, we hope you make it a part of your week because, you know, we have a thriving community who does, and we'd love for you to join that community. So thank you all for being here. I want to say a special thank you to our guest, Paul Shively, special thank you to Pablo, special thank you to Madison, and thank you to all of you. And I'll do my best job to leave the show, just as Pablo would leave it, with a friendly reminder that if you want to find the sources of capital to help you reach your financial goals, don't be average. See you, everybody.